Chapter 17, Learning Objective 2 and 3. Learning Objective 2 is pretty short, so we're going to combine these two. So first here, calculate the amount of money you must save for retirement in today's dollars. So how do you go about this? First thing you need to do is come up with a retirement savings goal or a retirement nest egg. Just figure out in today's dollars how much you think you'll need, and then you go through the calculations after you figured out how much you think you'll need. So building your nest egg or building your savings, you need to figure out how long you're planning to work and estimate how long you think you'll live in retirement. How long you work is going to depend on where you work, how much you make. If you have a defined benefit pension plan, a lot of times you can retire after 25 or 30 years, and you can fully retire, go on to work somewhere else, so forth. How long will you live in retirement? That's a little more difficult. Probably a good idea to think about your parents, grandparents, and so forth, how long they lived, and that's probably a pretty good indicator. The average for a male that reaches 65, reaches the age of 65, they on average live to about 86, and then a female that lives to 65 will live to, on average, somewhere around 88, about 2 years longer. So those are also good indicators to use as well. So then you need to project your annual retirement expenses and income. So how much do you have? What's your income going to be? Social Security, defined benefit pension plans, and so forth. So identify all that. Project your expenses. Figure out how much you currently have, and then the difference is going to help determine how much you actually need based on your interest earnings or investment earning assumptions and so forth. And so then you will come up with how much you need to deposit on an annual, monthly basis in order to make up the shortfall. Concept check 17.2 lists the steps in the process of estimating your retirement savings goal in today's dollars. This is, first thing, determine when you want to retire and what your savings goal is. This is on page 524 of the text. A little more detail than the slides covered. So figure out what your income needed at retirement is. Estimate your Social Security benefit. You figure out what your pension benefit from your employer is, if you have one. Then you determine your additional income needed. Calculate the present value of that. Then calculate your retirement assets available, then calculate your shortfall, and then finally calculate the additional retirement savings necessary to meet your goal. Learning Objective 3, distinguish among the types of employer-sponsored tax-sheltered retirement plans. So the funds that you put into your regular investment accounts are after-tax money, meaning that you've paid taxes on that money. The tax-sheltered retirement account is one which contributions are not subject to income taxes. We'll talk about different kinds. If you work for a private company, then you'll probably have what's called a 401k. If you work for a government, then you will have either a 403B or a 457 plan. they all effectively provide the same serve the same function. So your contributions are tax deductible to these types of accounts. They're not maybe pre-tax, but they're your contributions set to a non-employer plan may or may not be tax deductible. So that's a different issue. But in this case, they're going to be tax deductible. The earnings on there, so any interest or capital gains, is tax deferred. You don't pay taxes on it until it's withdrawn. You can accumulate more money by delaying the payment of taxes. You have ownership and portability. So if you have a 401k and you leave that company, you can transfer it to your new 401k, or probably even better option is roll it over into a rollover IRA. The very simple. Go online, go to any brokerage firm, and tell them you want to set up a rollover IRA, and you can do so in a matter of minutes, and you can transfer those funds from your retirement account, whatever it may be, 401k, 403b, 457 plan. So the some accounts can be tax-free, meaning that the withdrawals aren't taxed. This is the case for Roth type accounts, but these Roth type accounts are not funded with pre-tax money. Roth accounts are funded with after-tax money, but the earnings on a Roth account are tax-free. Table 17.1 shows the benefits of participating in a 401k. Would be the same for any other type of plan, whether it be a 457 or for 403b. The first column shows not participating in a 401k, and you can see if your taxable income is higher. Your federal income tax is higher by $1,500 or so. Your state income tax is higher by $250 or so. Your take-home pay is about $5,000 difference, but if you look in the right-hand column, you've put $6,300 into your plan, and if your employer offers a match, a typical match would be dollar for dollar up to 5%. Some might match 50 cents on the dollar up to 5%. Either way, whatever amount your employer is willing to match, you should go ahead and contribute that, because in this case, if this individual had a match that was dollar for dollar on this $6,300, instead of having $6,300 in contributions for the year, you would have $12,600 in contributions for the year. So you can see that it's free money, and as a result, your retirement savings are going to grow at a much greater rate. Employer-sponsored retirement plans qualify for tax sheltering, which we mentioned previously. The Employee Retirement Income Security Act, or ERISA, more commonly referred to, governs these plans. ERISA requires that these benefits are portable. So if you make contributions and your employer matches those contributions, leave your job, then they're portable. They can be moved. They can be taken with you to your new employer. They can be taken with you to your Fidelity or Schwab or any other brokerage firm's rollover IRA. You can also do rollover IRAs at your local bank. The investment options may or may not be limited there. Vesting is also important when you're talking about retirement benefits. The vesting means that you are entitled to receive those benefits. When I worked at a brokerage firm, we were awarded stock every year as part of our bonus. That stock vested over a 4-year period. So each year you would get a quarter of that stock would vest to you. So it took 4 years later to receive all of it. Same with some pension plans. I'm in teacher retirement system for the state of Texas, and vesting occurs there after 5 years. So once I've been at the university for 5 years, I will be vested and be entitled to a certain amount of retirement benefits under that plan. That's what we're talking about with regard to vesting. Cliff vesting would be, for example, if you had to wait like the 5 years for a teacher retirement system. The graduated vesting was what I was describing with regard to the stock when I worked at the brokerage firm. So we vested a quarter each year for 4 years. So different plans vest differently. It's very important that you look into these things, and stuff you need to think about if you're changing jobs between from one employer to the next. May or may not, probably won't matter if you're a teacher, for example, under teacher retirement system. If you go to another school that's under teacher retirement system for the state of Texas, then you would probably be okay, but it could cause problems. What we're talking about here, all these plans, 401ks, 403bs, 457s, are what defined contribution plans. And certainly in corporate America, they are today's standard. 30, 40 years ago, defined benefit plans were the standard. But the difference in the two is in a defined contribution plan, you're taking the investment risk. In a defined benefit plan, your employer is taking the investment risk. So big difference, because with a defined benefit plan, you're going to have a certain level of retirement income that is essentially guaranteed. Plans can be either non-contributory or contributory, meaning that the non-contributory means that the employer funds it all. Contributory plan means that you're going to fund a portion or all of that. In most cases, most of the retirement plans I'm familiar with are contributory plans. Benefits are based on the success of the investments made with the funds. So, whatever you make the investment selections, and your returns are subject to the success of those selections. We talked about this. Names of defined contribution plans, 401k plans. There are Roth versions, as I mentioned. The 403b plans, also with Roth versions. 457 plans. 403b and 457 are plans that are available to government employees, and those vary between employer. There are also simple IRAs or savings incentive match plan for employees. These are much rarer, but they are available at certain smaller companies. Matching contributions. Employers can fully or partially match employee contributions. As I said, the typical match is dollar for dollar. possibly up to 5%. Some government employees get much larger matches. The police and fire sometimes can get matches up to 20%, which obviously is a huge benefit. The limits on contributions, annual contributions, this is probably an old number. It may have changed a little bit, but I think this is 2014, $17,500 for the 401k, 403b, 457, and simple IRAs. Table 17.3 shows, well, your benefit and how much you give up with not receiving matching contributions. So the first column over here shows $2,800 of contributions and 0 employer contributions. So if you earned 8% for 30 years and you made the $2,800 contributions, you would have $317,000. So if your employer matched half of that, in this case they'd be depositing $1,400 a year. That difference would give you a total of $476,000 at the end of the year. So that would be a 50% match. So the next one is a 4% of the salary deposit and a dollar for dollar match. That means that you would end up with double the money in the account after 30 years, which makes sense. Double the deposits, double the earnings, double the benefit. So, and the last column just shows a 6% contribution and a dollar for dollar match. That ends up with a whopping $952,000. So, if your employer matches your contributions, I highly encourage you, I strongly encourage you to take full advantage of those matches. It's free money. There's no reason not to do it. There are also catch-up provisions. Workers over the age of 50 can contribute an extra $5,500 in most employer-sponsored retirement plans. This was done because many people have not contributed to retirement plans historically, and as a result, there are a whole lot of people out there that have almost no retirement assets. So these catch-up contributions have been allowed for some time for workers over the age of 50. Defined benefit plans, we've mentioned them earlier in this section. They used to be the standard. They still are for some government employers. Some government employers are moving towards hybrid plans, which are a combination of 401ks and defined benefit pension plans. But in corporate America, the defined benefit pension plan has pretty much gone the way of the dinosaur, unless you're a high-level executive. They're typically the only ones that have any kind of defined benefit retirement plans in today's world. The defined benefit plans, this is not correct either. Defined benefit plans are not totally employer funded. They are employer funded, but for example, my contributions, the state matches my contributions to the teacher retirement system state teacher retirement system of Texas. And the state, as I mentioned, the state's responsible for the investment returns. So, but they are required to make contributions on top of what I contribute. Benefits are based on a formula that uses salary and years worked for the employer. These have changed in recent years. Typically, in recent years, as a result of the cost of these type of plans, the formulas for salary have been extended to cover a larger number of years to combat what's called spiking, which is when people work overtime in the last years that they work and increase their retirement benefits by doing so. The years worked is also part of the formula, and there's typically somewhere in the neighborhood of 2% of your salary per year. It can be slightly less than 2% or slightly more than 2%, and that adds up each year. So, for example, if you were receiving 2% of your 2% of your salary and you'd work for 30 years, that would be you would receive 60% of your salary at retirement, and that would be based on an average of something anywhere from probably your last 3 years to your last 10 years. Something that was probably the outside as far as the average of your salary, which would be calculated. You can do normal retirement or early retirement. For example, if you have a defined benefit pension plan with, you were a school teacher, or you were in the military, or you worked for the Postal Service. A lot of those people retire from those jobs around 50 or 55, and in some cases you can start receiving benefits at that time, or you can wait until you're 65 to receive those benefits. If you wait until you're 65, you will receive a larger amount of benefits. There are also disability and survivors benefits, or also referred to as joint and survivors benefits. If you are married and you participate in a defined benefit pension plan, it is a very wise idea to attach your spouse to that pension plan. The reason being, if you pass away at some point, your wife will continue, or wife or husband will continue to receive those benefits until they pass away if you attach them. This decision is usually made at retirement. You can either elect to attach them or not attach them. It will reduce the amount of benefits that you receive, but it is a nice piece of security for your spouse. I mentioned hybrid plans previously. Cash balance plans are a type of hybrid plan that includes both defined benefit and defined contribution aspects. These are set up so that the employer is taking some of the investment risk, and the employee is taking some of the investment risk. The idea is that you share the investment risk. Other examples, ESOPs, or employee stock ownership plans, or profit sharing plans. ESOPs, typically the employers contribute stock to an account in the employee's name while the employee is working, and as long as the employee has vested in that account, they at the time they leave the company, they will be able to take that stock with them. Profit sharing plans are similar. Okay, concept check 17.3, distinguish between after-tax money put into investments and pre-tax money. After-tax means that you've already paid taxes. So you're going to be depositing a reduced amount to that account. Taxes are not paid on pre-tax money until the money is withdrawn. So simply, you don't pay taxes on the deposits, and you don't pay taxes on the on any investment earnings until you withdraw that money. So explain what is meant by tax-sheltered investment growth on money contributed to qualified retirement accounts. Again, you don't have to pay taxes until you withdraw money from the account. Okay, summarize the main differences between defined contribution and defined benefit pension plans. The worker takes all the investment risk on a defined contribution plan. The employer takes all the investment risk with a defined benefit pension plan. Explain why a defined contribution plans are called self-directed. They're called self-directed because the worker chooses the investments. So finally, offer your impressions on working for a company that offers a sizable matching contribution compared with one that does not. Matching contribution is a huge benefit. Everything else equal, the employer that offers a matching contribution would be preferred because you're going to be able to save at a much greater rate. That matching contribution is going to accelerate your retirement savings.